So now that we've discovered that stock picking, track record investing, and market timing have been proven empirically to not be good ways to invest your money, let's talk about the fourth myth, the cost of investing, when we add up all the total costs in a portfolio. And the definition of the cost of investing are pretty obvious. Fees incurred by investors to buy, sell, and own stocks or mutual funds. The myth is what you don't see can't hurt you. And these are costs that maybe you or even your investment advisor are completely unaware of. So let's see what the costs of investing are. What you don't see can't hurt you. We're going to talk about two very specific costs, the bid-ask spread and the cost of mutual funds. If I called my broker up and I said I wanted to sell 100 shares of large company XYZ stock, my broker may say, you can sell that for $49.50. And then I think to myself, I didn't mean sell, I meant buy. I want to buy 100 shares of the same stock, 100 shares. How much can I buy those for? It'll be $50. So where does the price difference go between the buy and the sell price? The spread of 50 cents. Well, I know you've seen the floor of the exchange with all those crazy guys running around with tickets in their hands and the yellow jackets. Maybe you've seen them behind the talking heads on CNBC, or you've seen them in a movie somewhere. These are market makers or specialists, and they work for the large brokerage firms, wirehouses, and investment banks. They're the ones who get the spread. You might think that you get to sell your shares directly to another investor, but that's not true. You sell it to the market maker, the specialist on the floor of the exchange, and that's how they make their juice. That's how they make their money. So when you look at trading shares of a stock, the size does make a difference. If you look at the top of the chart, large cap stocks, being your Fortune 500 companies, it would cost you 0.03% to buy and 0.03% to sell. A round trip, 0.06% plus commissions could be a little over 0.5%. You can see in the middle, the medium-sized companies, 0.08% to buy, 0.08% to sell. You're still at, when you add in commissions, just a little over 0.5% to buy and sell. But I know you've seen those E-Trade Baby commercials or the low commission, no commission trades that you can make during the Super Bowl. Well, these are basically based on small company stocks. We're going to talk about why this is important a little later when we talk about small company stocks. But if you look at the very bottom, you can see that it can cost you 4.37% to buy and 4.37% to sell. So a round trip is about 8.8%. When you add in commissions, you're a little over 9%. So thanks for not trading or charging me commission E-Trade. You just charged me 9% for a round trip in my entire portfolio. And this is important when you look at the costs in mutual funds. And in the book, How to Win the Loser's Game, written by Charlie Ellis in 1985, and costs have came down some since. But the key question under the new rules of the game is this: how much better must an actively trading, stock-picking manager be to at least recover the cost of portfolio turnover? The answer is daunting. So when you look at no-load mutual funds, consumer no-load mutual funds, you can look at expense ratios for mutual funds that average about 1.19%. Now that's shown in your prospectus. You know those costs. But if you add in the turnover ratios, which can average about 100%, the trading and bid-ask spread costs of mutual funds are increased. You can pay up to 4.17% just in the hidden cost in a mutual fund, and these are not included in your prospectus or the expense ratio of your mutual fund. So when you add trading, bid-ask spread costs to expense ratios, you can easily pay a little over 5%, almost 5.5% of your investment money inside of a so-called no-load mutual fund. So no-load mutual funds are not load-free as you might expect. So far we've talked about the three investing myths: stock selection, track record investing, market timing, all of which we've proven do not consistently and predictably work. And then we found out what you can't see can hurt us because of the cost of investing that extract a huge return out of our investment portfolio. Now I'm going to tell you a refreshing story. You're going to get on to the truth about investing, the true story of investing. And this is a good news, bad news story. So go on to the next video and we'll talk about the story of investing.